All right, so we begin our discussion of forming and operating partnerships in Chapter 20. And many of the concepts involved here are similar to what we saw in forming a corporation. If you recall, when you form a corporation, you could be subject to Section 351, which when you contribute property to the corporation in return for an interest in the corporation, if you plan it right, you have a tax-free transaction. Many of those same concepts are here in forming and operating or forming partnerships. And so partnerships are flow-through entities, which means that you're only taxed, the owners are only taxed at one level, the owner level. The partnership itself is not taxed, even though, and so when they file their Form 1065, they're filing that to the IRS for information purposes only. What they have to do is, in addition to filing the Form 1065, is they have to attach what are called Form K1, and those K1s are sent to the various partnership or partners, the owners, and what the K1 does for the owners is it sets out the various items of income, deduction, expense, what they call separately reported items for each partner. And so again, for reporting purposes, the partnership does not pay tax. They simply report to the IRS. All right, so the question down here, this aggregate versus entity concept. What they're talking about there is when you contribute property to a partnership, the question is, does the entity own, and this is just one of several questions when you're dealing with aggregate versus entity, but this is a good start. When you contribute property to a partnership, who owns it? Is this property in the partnership owned by the individual partners, or once it's contributed to the partnership, does the partnership own it? And so the entity concept says, well, the partnership owns it. They have control over it. They can do what they please with it, use it, dispose of it, whatever. It's the partnership that makes those decisions. And for most things, the entity concept is in place for partnerships. As far as accounting methods and tax years and things like that, the partnership decides those things, not the partners. Now, the aggregate concept comes into play when you're dealing with things such as profit sharing, and taxes. So each individual partner is responsible for the taxes. So that's the aggregate approach, not the entity approach. So anyway, bottom line is partnership law is kind of a mix of both, but for the most part, Congress decided that the entity concept would rule in most situations. And so the entity approach treats tax partnerships as entities separate from their partners, whereas the aggregate approach treats tax partnerships as an aggregation of the partners' separate interest in the assets and liabilities of the partnership. And for the most part, entity approach wins out. And again, when it comes to the subject of taxes, partnership law takes the aggregate approach. Each partner is responsible for their portion of partnership income, expenses, losses, deductions, things like that. But because the partnership makes most of the tax elections, that represents the entity concept. All right, so here we're talking about the initial formation of a partnership. We're not talking about an existing partnership and someone who is not a partner buys an interest in the partnership. That's a little different than what we're talking about here. So we're just talking about a new partnership with partners coming together to form it, and they're contributing property to the partnership. And so what the partners forming the partnership get is a right to really two things. They receive what's called a capital interest, which is their right upon liquidation of the partnership to receive their portion of the remaining assets. They also acquire, when they contribute property to the partnership, a profits interest, which simply is a right to their share of future profits or losses in the partnership. So, two types of interests are acquired when you contribute property to a partnership in return for a partnership interest. Now, compare partners who contribute property and what their rights are to partners who receive a partnership interest but don't provide any or don't contribute any kind of property. They are getting a partnership interest in return for services. These are called service partners. What they can get are one of two things. They can get a capital interest, but many times what they get is a profits interest. Because if they get a capital interest, the other partners are having to give up a portion of their potential ownership interest in the partnership. So many times what service partners get is a profits interest, not a capital interest. Now, when you contribute property, for the most part, what's going to happen is any built-in gain or loss is deferred for tax purposes. So it's very similar to Section 351 when we talked about forming a corporation. As the book points out, because if you contribute lost property to the partnership, because that loss is deferred, it makes more sense if you're gonna do anything with lost property is just simply sell it, take the proceeds, and contribute the proceeds to the partnership. Note that the term property, just like we saw with corporations, is broadly defined to include cash, tangible property, and intangible property. And so neither the partnership nor the partner who contributes the property recognize any gain or loss when they contribute the property to the partnership. Now note here, well, we talked about this, built-in gain property encouraged, built-in loss property discouraged from contributing, just sell it and contribute the proceeds. Now we have this thing called basis that you've learned about, and with partnership tax we have two distinctions. We have outside basis and inside basis that you need to be familiar with the concepts relating to those things. And so the partner's initial tax basis, well, the partner's basis is called his or her outside basis. Now, the partnership's basis in this property is called the inside basis. As far as the partner's initial tax basis, it's going to be whatever the basis is in the property that they contribute to the partnership. Now, when you have debt, it gets a little more complicated, but still manageable. When the partnership has debt, each partner must include his or her share of the partnership's debt in calculating the tax basis in the partnership's interest, in the partnership interest. And so what that does when you have debt, the law treats each partner as borrowing her or his proportionate share of the partnership's debt and then contributing the borrowed cash to acquire their partnership interest. Now, there's two types of debt that you have to consider when you're figuring out a partner's tax basis. There's recourse debt and non-recourse debt. Recourse debt is debt that the partners, usually through some sort of personal guarantee, sign with the lender saying that if the partnership doesn't pay it, they'll pay it personally, and the partners are on the hook for that recourse debt themselves. Well, some of the partners may not sign off on that, so it might be the recourse debt could just be guaranteed by some of the partners, but not all. When you have recourse debt, you have to allocate that debt to those partners who have guaranteed the debt, guaranteed to pay the debt should the partnership not pay it. And so you allocate that based upon their interest in the partnership. Now, non-recourse debt is debt that creditors, in which creditors cannot go after the individual partners if the partnership does not pay this debt. Non-recourse debt is simply allocated to each partner based upon their profit share. When I say ownership interest, that may be a little misleading, because profit sharing ratios could be different than ownership interest. So it really is ownership interest in that case. Or excuse me, profit sharing ratios in that case. Okay, so you've got 3 partners, or let's say 4 partners, and they have profit sharing ratios of 25% each. You've got non-recourse debt of $200,000. You're simply going to allocate according to the 25%, and so a quarter of the $200,000 debt is going to be allocated to each partner, so $50,000 to each partner. And so that recourse debt and non-recourse debt, by adding that to each partner's basis, increases their outside basis. Now, another thing that happens sometimes is a partner will contribute property to the partnership, and that property is secured by a debt. And so when that happens, that contributing partner is relieved of all or a portion of that debt securing the property. And so in that case, your outside basis of the partner contributing the property must also reflect the partner's debt relief and any gain recognized from the debt relief. Now, that last part, and any gain recognized from debt relief, is an exception to the rule. And if you look on at the bottom of page 6 of the text, it says that an important exception to the general rule of no gain or loss is when the property secured by the debt contributed to the partnership the contributing partner recognizes gain only if cash deemed to have been received from a partnership distribution exceeds the contributing partner's tax basis in the partnership interest prior to the deemed distribution. And so you have an example there, example 20-5, and we'll see this again in a sample problem. The same example where you have this well, two of the three partners guarantee $100,000 debt. 40 of that 100,000 is mortgage on land that Nicole, the third partner, contributed to the partnership. And what Nicole contributes to the partnership is $20,000 basis in the contributed land, and she kicks in $10,000 of cash. And so what she contributes is a total of $30,000, but she's being relieved of $40,000 in debt. And so in that case, this is an exception to the rule. When the debt that the contributing partner is being relieved of is greater than the basis of the property contributed, they're going to recognize a gain between the two amounts. And so here she recognizes a capital gain of $10,000, the difference between the $40,000 debt relief and the $30,000 of property that she contributes. All right, so this just kind of sums up what I've already talked about as far as recourse debt and non-recourse debt. So make sure you look over that. Now, the holding period, the contributing partner's holding period in the partnership interest depends on the type of property contributed. If the property is capital asset, or what they call 1231 asset, which is asset used in a trade or business, then they simply get a carryover basis, or excuse me, carryover holding period of the partner. And so, let me say that over again. The partner's partnership interest, the holding period of the partnership interest, carries over from the time they owned the capital asset or 1231 asset. Okay? So if the property that they contribute is capital gain asset or 1231 asset, their holding period simply to the partnership interest simply tacks on to however long they own that capital gain property or capital property or 1231 property. Now, if it's something else, then the holding period is simply on the day the partnership interest is required or acquired. Now, as far as the partnership is concerned, partnerships generally take a basis in the property equal to the contributing partner's basis at the time of the contribution. So, at least at that point, as far as the property is concerned, at least, inside basis and outside basis are the same. Of course, that's before you make all those adjustments to the partner's outside basis. The holding period for the partnership also carries over. So however long the property was held in the hands of the partner carries over to the partnership. All right, so here's some examples. When CCS was organized early 2010, Nicole contributed $10,000 of cash and land with a fair market value of $150,000 and adjusted basis of $20 to CCS. Land was encumbered by a $40,000 non-recourse mortgage executed 3 years before, recalling that CCS already had $60,000 in bank debt. And I guess you'll have to run through these examples in the book to bring yourself up to date. Really what this is example looks like this is example 4 or 5. I think this is a 4. So anyway, recalling that CCS already had $60,000 in bank debt before Nicole's contribution, what tax bases do Nicole, Sarah, and Chan's Inc. initially have in their CCS interest? Now notice here, here's another interesting thing that I don't think the book really talks about, but certainly it was talked about in chapter 15, who can be a partner in a partnership. Well, it could be individuals, but it could be corporation, right? So in this example, we have a mix of both. So what tax bases do Nicole, Sarah, and Chan's Inc. initially have in their CCS interests? So what you have here is the example in example 20-4. And so, again, Nicole contributes land with a basis of 20, cash of 10. You have to increase her basis by her portion of the $60,000 recourse bank loan, and then there's another $20,000, so she gets 20 of the 60. As far as non-recourse mortgage, each one of the partners takes their portion of that non-recourse mortgage, so $6,666. And for Nicole, you have to also consider the fact that she's being relieved of $40,000 mortgage debt, which reduces her basis. And so her basis initially is $36,666. Now here, this is example 20-5, and this is an exception to the general rule that partners don't recognize gain when they contribute property to a partnership in return for a partnership interest. You've got a situation where only Sarah and Chan's Inc. are personally guaranteeing the $100,000 of debt. So she doesn't get allocated any of that debt. And so basically all you have for her are the $30,000 value, the tax basis in the land, and $10,000 cash that she contributes. But the debt she's being relieved of is $10,000 greater, $40,000 being $10,000 greater than $30,000. And so she has to recognize a $10,000 capital gain because of that reason. Now again, as far as contribution of services, you can have either a capital interest or a profits interest. Normally what a service partner is going to get is a profits interest, not a capital interest. But let's say the service partner negotiates the deal and, gets a capital interest and a profits interest. So let's start with, let's say the service partner only gets a profits interest. Well, if they only receive a profits interest, that profits interest has no what we call liquidation value, like with a capital interest, because they don't, upon liquidation, a service partner with a profits interest gets squat. So there's no liquidation value to the profits interest upon receipt of that profits interest. Therefore, the service partner who has only a profits interest will not recognize income, at least initially. And non-service partners will not receive a deduction for anything they pay the service partner, because there's nothing to deduct yet. Now, when they receive also or instead of a capital interest, this represents a current economic entitlement that it is possible for them to measure. Remember, this capital interest says that the partner holding a capital interest has an interest in partnership assets should it liquidate. So the service partner can determine that liquidation value that they would receive. Because it's subject to measurement, the service partner receiving the capital interest is going to report ordinary income equal to the value of that, what they would receive in liquidation. Now, on top of that, the service partner's tax basis in the capital interest is the amount of the ordinary income that they recognize. The other partners on top of this are allowed to deduct let's see where that is. Well, the non-service partners, meaning the other partners, will be able to deduct the value as an expense of the service partner's value, liquidation value of their capital interest. So look at example 20-8, and then at the top of page 11, I think they give you an example of that. So here on December 30th or 31st of 2010, all members of CCS agreed Sarah would receive an additional capital interest in CCS with a liquidation value of $20,000 and an increase in her profit and loss sharing ratio from 33 1/3% to 40%, leaving the other members with 30% each. To compensate her for the time she would spend on an additional project. At that point, CCS's debt was $100,000. What are the tax consequences to Sarah and CCS of giving her an additional capital interest? Well, she recognizes the liquidation value of the capital interest as ordinary income. And then the other two partners get to deduct the amount of that present, or not present value, but liquidation value of income that Sarah recognizes, and since it's proportional, they each get $10,000 each. Says here, assuming Sarah receives only a profits interest, what are the tax consequences to Sarah, Nicole, Chans, and CCS? Well, none. Well, except the debt allocation. She goes from 33 1/3% to 40%. So you have to increase her debt allocation and decrease Nicole's and Chans's, which is going to increase her outside basis by $5,334, and then the other two partners get a decrease of $2,667 each. All right, so here they just kind of give you the formula, tax basis of a purchased partnership interest. Okay, so this is an existing partnership and somebody wants in. Now that could be buying out one of the existing partnerships' full interest, or it could be a partner just simply, or possibly even the combination of partners simply reducing their interest to bring in a new partner. And so the tax basis of a purchased partnership interest equals the purchase price plus partnership debt allocated to that partner, and the holding period begins on the purchase date. Organization, startup, and syndication costs. Don't want to spend a lot of time, but as far as organization and startup costs, it's kind of like what we looked at with these costs with with setting up a corporation, you get to take an automatic deduction of up to $5,000 in each, with the balance of the organization or startup costs being amortized over a 180-month period. I think all this is in Chapter 10 if you want to look back at that. And again, same deal if your organization or startup costs exceed $50,000, then you have to reduce that immediate $5,000 deduction by the excess over $50,000. So it basically, bottom line is, if your organization and or startup costs are $55,000 or more, you don't get any immediate deduction for those costs. You simply have to amortize whatever those costs are over a 180 month period. What about syndication costs? Well, those just aren't deductible at all. So tough luck there. All right, so tomorrow I will start up with partnership accounting methods, accounting periods, and tax elections, and finish out the chapter.